what's going on with the Fed and the big meeting this week. We do care about it. Steve, thanks for joining us.
I just like listening to what you guys are talking about, Courtney. I'm learning from, what the market expectations are there. What I know is that the market is on board completely with that first hike or the hike coming this week, and less so for the second hike, and that's a matter of debate. I think, Courtney, one way to think about it is to think about real rates, and what that tells me is that the Fed wants a real or inflation-adjusted rate that's far higher than where it is right now. I got a chart up here. Here's the Fed. Now, let me just walk you through the math here. What that is that's the Fed funds rate, the current one, minus the 1 year ahead expected inflation from the New York Fed. So the real rate's 1.3, but you look at where the Fed thinks it ought to be by the end of the year, take their PCE forecast minus their expected funds rate of 5.6, and they think they ought to be pretty tight. And then look at the bottom there, the long run rate, 0.5%. That tells me that there's a lot of folks on the Fed who think that 50 basis points of tightening is what's required to get this economy into a place where inflation is near or on the way to the 2% inflation target.
And so Steve, the Fed's 50 basis point, you're thinking then we get 25 this week, 25 more in September?
Yeah, and now, of course, there's two variables when you calculate a real rate, Courtney, as you know. One is the nominal rate, the other is the inflation rate. The Fed can get more of the real rate it thinks it needs if there's a sharper decline in inflation. It won't have to do so much. But right now, one way to think about it, and there's the math right there, just so people understand, how do you get a 1.3 real rate? You take the nominal rate, you subtract out some inflation number. Now, just so you know, that second line is a matter of debate. Right? Do you use current inflation? Do you use future expected inflation? I've been talking to Jeff Lacker, from former Richmond Fed president. He thinks that the inflation expectations number is the way to think about what the right real rate is. So that's where you come up with the 1.3. Now, the Fed has dialed in a decline in the inflation rate. If it gets more than it forecasts, it won't have to do so much. But the idea of thinking about 50 basis points, I think that ought to be a part of the investment thesis around the table there from those bright people you're talking to, Courtney.
Hey, Steve, it's Joe. Good to see you. Shouldn't we be thinking, though, about where the Fed funds real rate is, just in terms of is it restrictive or not? Whether they're able to stretch it a little bit further. 1 year ago or 13 months ago, it was negative 8%. It's in restrictive territory. Isn't that kind of what matters most?
That is exactly what matters most. And if you don't mind, Joe, I think I brought along, they may have in the back there, a long-term historical chart of the real funds rate, in which I simply subtracted that. Oh, they're so good on the back there. So here's what you're looking at. That's the real rate minus the PCE inflation rate. Notice that it was up near 12% real in the Volcker years, okay? But I want you to look at that section around 1993. Notice how it was up near 3-4% during that entire period. That was a period, by the way, of strong technological advance, a time of high investment. Sometimes when there's high investment, you need a higher real funds rate. And then Joe just correctly pointed out that it has been negative or stimulative during most of the time in the post-Great Financial Crisis period. And just now, just in the past 5 months, it's gotten to be positive, which doesn't mean it's restrictive. Remember that just because it's positive, if you think of a neutral rate, a neutral real rate being 0.5%, it has not been restrictive for all that long.
Wow. That is pretty fascinating.
That's
I like
just a 40-year economic history, just like that.
Just like that, and just one chart.
Everything you need to know.
I love it, Steve. The professor is back. Thank you very much.